All right, so let's begin the show. And we all know the markets has been sideways, clearly a very stock-specific movement and action that's been witnessed. But then, where's the market headed? And we get you a lot of experts to shed lights on what's on their mind, especially throughout the day. But then, what are the fund managers thinking? What is their take on strategy as well as their understanding of the current movement of the market? Let's decode all of this today. I have with me Karthik Kumar, fund manager, Axis Mutual Fund. Karthik, hi, good evening, and welcome to the show. Clearly, the market is sideways, a lot of stock specific movement that we are witnessing. But then, this is a time where investors can't decide or are not able to decode. It's time to enter the market or it's time to book profit if at all they are into any. As a fund manager, what is the kind of sense that you are making out of this current market movement? Do you look at it as a very healthy correction that was needed, which was overdue, and it's time for investors to just hold on for some time, take a pause, and then later on see as to if at all new money is to be put in the market?
Thanks for having me on the show. We need to put things in perspective, right? We are coming off a very strong 2023 and December 2023 in particular. So Nifty was up 21% for the year of 2023, and it was up just 8% alone in December. So I think it's very natural for markets to take a pause subsequently. And this is also healthy in a sense, as you mentioned, because it cleans up a lot of the froth. So I don't think it's unnatural in any way. Second is that there is also a seasonality thing to this. So if you look at starting 2001, the Jan to March quarter traditionally has been the weakest quarter for our market. So 54% of the time, the Jan to March quarter has resulted in negative returns, and the average return during this period has been around negative 1%. So there is a seasonality aspect to it. But there's a third angle to it, which is like the heavyweights, both from a sector perspective and from a stock perspective, have reported slightly disappointing numbers early in this reporting season. And so that also has contributed to the volatility. I think all the three factors together explain why our markets have been a bit sideways to slightly down over since the turn of the year.
All right, Karthik, specifically talking about valuations, because a lot of concerns regarding this has come up in the investors as well. Talking about mid cap and small cap, according to you, are they really in an overvalued zone? And the kind of volatility we are witnessing now, mid cap and small cap would be the first one to give up, and we will see the trajectory movement being shifted towards the large cap. In terms of valuation, how do you see it across market caps right now in this current market moment?
Okay, let's just break that down. So if you look at large caps, they are trading at 20 times, almost 20 times next year's earnings, which is not outright expensive on an absolute basis. But if you were to compare it to our regional markets, we are trading at a significant premium to our regional markets. Now, if you come down to mid caps and small caps, they are trading at their all-time highs in terms of valuation and on an absolute and a relative basis. If you were to look at their contribution to market cap, mid caps and small caps now contribute around 18.5% of the market cap individually. So that's the highest that they've ever contributed. So all these things highlight one point, which is that the asset revaluation or the gain through just expansion in multiples for the asset class, which is the mid cap and small cap, is pretty much done. What is important right now is stock selection. What has supported this expansion in multiples over the last year and a half is essentially the earnings differential was very much strongly in favor of the mid caps and small caps, and it was quite sizable compared to the large caps. Now, as we go into FY25 and FY26, that differential in earning growth rate comes off drastically. So again, in this case, what matters is stock selection and being very picky about stocks in these in mid cap and small cap. So just to kind of summarize, I think from a risk reward basis, large cap as a space looks quite attractive. But having said that, there are still opportunities in the mid cap and small cap space at a stock level.
Also, let's talk about the global trends, and then perhaps what kind of a new risk an investor needs to keep in mind. Because if we talk about the global trends, there are signs of softening economies, and concerns over inflations were not have not come down as we were expecting it, by the end of December 2023. So the scenario has quite changed over there. Talking about new signs of concern, or new risk factors, or those triggers that could just spoil, or just take us off tracks. What could those triggers be according to you?
So, firstly, as a house, we remain quite constructive on our markets in general, primarily because our GDP is quite resilient, and its expected growth rates, both from economic perspective, also from a market perspective, the growth rates are one of the highest in the region and also globally. So, we are quite constructive on the markets. Now, if you were to talk about as long as there is a softening in US economy, or a soft landing, and the European markets kind of experience a mild kind of recession, so that should result in benign commodity prices, and hence benign levels of inflation. At least the trajectory should come down, which should give central banks much more room to maneuver their interest rate policy. Environments like this typically are quite conducive for emerging markets, both in terms of flows as well as in terms of performance. So I think the macro environment, as long as it stays within the kind of spectrum that I've kind of laid out, should be good for emerging markets and our markets in particular. And from a style perspective, I think that the kind of style that should do well is like a GARP like style, where you're focused on growth at reasonable prices. That the kind of style that we follow within our investment platform should kind of do well. And from a risk perspective, I would lay out two main things. Primarily, the geopolitical developments in Middle East that could have ramifications in terms of regional stability, commodity impact on commodity prices, and also supply chain disruptions, which in turn could lead to inflationary effects globally. The other thing to keep an eye out for is what is happening in China, the government's efforts to kind of stabilize the economy and the markets. They are taking active steps, but it is just something to watch out to make sure that that is going the right way as well. So those are the two things that I would highlight from a risk perspective.
All right. Quickly, Karthik, along with this, let us talk about Axis Quant Fund. And as far as the exposure across market caps is concerned, the kind of split that you've decided for the fund, it's majorly a large cap driven, where I can see a 66% exposure in large. Mid cap has almost around 18.5, and small cap around 14.2. What's the kind of strategy that you have opted for this kind of a fund? It's majorly large cap driven. If it is, how is it differentiating from the rest of the quant funds available?
Okay. So firstly, this fund is completely cap agnostic. So while there are broad ranges that it works in, basically it comes down to where is the opportunity, stock selection opportunity from a bottom up basis, and we are happy to go with that. So right now, the split as you defined is quite balanced. While it is around 60% in large cap, we have got sizable exposures in mid caps and small caps. The philosophy with regards to investment is we are focused on the style, as I defined as I call it GARP, which is quality and growth at reasonable prices. That is what we are focused on. And in terms of our positioning today, we continue to remain bullish pharma. We continue to be bullish on automobiles, primarily driven by two-wheelers and two-wheelers ancillary industries. And we remain slightly underweight within financials, largely the big banks. And we are also we continue to remain underweight on the IT sector.
All right. Did you say you're underweight on FMCG and IT sector right now?
No, I'm underweight on the financials, largely coming from the
Okay.
big banks and the IT sector.
Financials and IT sector, sectors where you are consistent as far as your exposure is concerned.
All the other sectors barring, so I've highlighted two. So I overweight pharma, I'm overweight consumer discretionary, and I'm overweight the power plays. And the other two sectors that I highlighted were largely the underweights, and the rest I'm largely in line with the markets.
Going ahead, for a few more quarters, as far as FMCG space is concerned, because we have triggers like budget and we also have triggers like the elections coming up. Although it won't be feasible for you to just change the strategy owing to these triggers, but then I just want to understand in coming quarters, do you see banking on sectors like FMCG, healthcare and power especially?
Mhm. Hello.
Yeah.
Yeah.
Yeah,
So
Karthik, go on. Sure.
yeah.
Yeah.
So with regards to FMC, with regards to power and healthcare, we remain quite constructive in both those sectors for fundamental reasons, and that comes out through the quant model as well. With regards to FMCG, I would be much more selective within that space and go for stocks where there is reasonable visibility in terms of growth. Because right now in FMCG, what we are seeing even through the earnings season is that the with the companies that have reported so far, the volumes have been quite subdued, and so the numbers both at a top line basis and a bottom line basis, while they have been in line, they've been nothing great to write home about. So that's something to keep an eye out for. The commentary so far has been quite tepid from the companies that have reported as well. So those are the things that we would keep an eye out for. And if the sentiment does change, if the outlook does change, then happy to align our portfolios accordingly. But so far, it looks like there could be better opportunities down the road.
All right. I think that will be all because my time is up for this discussion today. Karthik, thank you so much for being on the show and helping our viewers with the market trajectory and also the fund in specific questions. Thank you so much.
Thanks a lot.
We move on to take a quick break, and post that, let's get our viewers on board and let's solve their financial portfolio queries live on the show.